Every government claims to serve the people. Every politician promises stability, prosperity, and growth. They march in parades. They give speeches. They are the faces you see on the ballot. But behind the speeches, behind the campaigns, there is another force, quieter, more technical, but far more powerful. That force is the central bank. Central banks don't run for office. Most people can't even name the people in charge. Yet, these institutions decide how much money exists. They decide who gets bailed out, which banks live, and which banks die. They can make your mortgage cheaper, your savings worthless, or your retirement fund collapse. And they can do it all without a single vote from you. This is the secret history of central banks, how a handful of institutions became the real power brokers of the modern world. A quick dramatic montage, shots of Washington, D.C., the Capitol, quickly replaced by shots of the Federal Reserve Building, then the Bank of England, then images of money-printing presses and complex financial charts. To truly understand their rise, we need to go back to a time when money wasn't even paper. We need to go back to the moment the engine of modern debt was first cranked into existence. The most shocking truth isn't just that they created this power, it's how they managed to convince the world this was the only way. And it all started with a king desperately needing cash for war. Birth of the debt engine, the Bank of England, 1694. The king's desperate need. The 17th century in Europe was a period of relentless turmoil. Wars drained treasuries, leaving coffers empty. Kings spent lavishly, driven by ego and empire building. Governments were constantly short on hard money, gold and silver. In England, this crisis reached a head with King William III. He desperately needed cash to fund a massive war against France, but the established lenders were wary. The Crown had a notorious reputation for defaulting on loans, breaking their promises. Lending to the king was a death sentence for your capital. This is where the political genius, or perhaps the financial trickery, of the central bank idea began. The deal with the devil. Money backed by debt. A group of private merchants and bankers came forward with a proposition. They would loan the government a substantial sum, £1.2 million, at a high interest rate of 8%. In return, they asked for a very specific, special privilege. This was the birth of the Bank of England in 1694. The privilege was simple, yet revolutionary. The Bank of England was given the right to issue notes. These weren't notes backed 100% by gold or silver. They were paper promises backed by the government's debt. Think about that. For the first time, money in circulation was not just metal coins, but paper backed by the credit of the state. The Bank of England effectively became both the king's creditor and the nation's banker. The lesson was clear, and it became the enduring mantra of central banking. Control the flow of credit, and you control the state itself. The spread of the model. While Sweden's Riksbank was technically founded earlier in 1668, it was the Bank of England's model, tied inextricably to the state's debt, that became the prototype. Other nations quickly copied the model. Over the 18th and 19th centuries, central banks spread across Europe, always tied to governments that needed reliable credit for wars, empires, and industrial expansion. By the Napoleonic era, The link between war and finance was undeniable. Napoleon's armies marched on gunpowder, but they were funded by credit. Britain's ability to borrow through its central bank gave it the financial muscle to outlast France. The pound sterling, backed by the Bank of England, became the anchor of the global financial system. Wars were not just won on battlefields, they were won in the balance sheets of central banks. The entire European world had been roped into this debt-backed system, but one young nation across the Atlantic stood defiantly against it. Why did the United States refuse a central bank for so long, and what finally broke their resistance? The answer lies in the chaos of a fragmented system and the power of one man. The American Anomaly. From chaos to the Fed. A century of financial chaos. The United States, born out of a revolution against a European monarchy, was deeply suspicious of centralized financial power. They feared a central bank would inevitably favor the elite and exploit the working class. For decades, the American financial system remained fragmented and chaotic. Banks issued their own notes. There was no single unified currency. The system was prone to panics, bank runs that erupted whenever public confidence failed. The Panic of 1907, the private bailout. The most famous of these panics came in 1907, a collapse on Wall Street triggered by a failed attempt to corner the stock of the United Copper Company, quickly spread across the country. Banks failed. Depositors panicked. The entire system was teetering on the edge. The man who stepped in to save the day was not the government. It was a private banker, J.P. Morgan. From his legendary mansion, Morgan summoned the other powerful financiers of New York. He literally locked the doors and forced them to provide the necessary liquidity, the cash, to stop the panic. The message was staggering. One man had stabilized the American financial system more effectively than Congress. For the political class, this was both humiliating and terrifying. Humiliating because a private citizen had more financial authority than the state. Terrifying because the stability of the entire economy rested on the health and judgment of a single banker. The birth of the Federal Reserve, 1913. America needed an institution that could act like Morgan, but on behalf of the nation. The political solution had to be crafted carefully to overcome deep-seated public distrust. After years of debate and, crucially, secret meetings on Jekyll Island, a private retreat where bankers and politicians drafted the plan in secrecy, Congress created the Federal Reserve System in 1913. The Federal Reserve, the Fed, was designed to be an independent entity, shielded from day-to-day political pressures, but deeply connected to Wall Street. Its core powers were immense. It could issue currency. It could set interest rates. It could act as the lender of last resort. In effect, it was America's new financial engine, privately influenced, publicly sanctioned. Few people realized how much power had just been created. You've seen how central banks were born out of royal debt and private panic, but their true power was unleashed by a force far greater than any king or banker: total war. Before we delve into the dark consequences of World War I, if this analysis is giving you a new perspective on how the world works, take a second to hit subscribe. That simple action helps us expose these powerful truths. The gold anchors snapped. WWI, Weimar and the Depression. WWI, The printing press as policy World War I was the first great test of these new central banking systems. The costs of industrial warfare were staggering, requiring resources on a scale no nation could fund with taxes alone. Central banks stepped in. They printed money, issued bonds, and essentially kept governments solvent by monetizing the debt. The gold standard, the old anchor of money, was quickly abandoned as nations suspended the convertibility of paper money into physical gold. The lesson was brutal. When governments face an existential crisis, central banks will always finance them. The printing press was no longer a last resort. It was policy. Case study: the Weimar hyperinflation. By the end of the war, inflation had ripped through Europe. The German Reichsbank, under intense political pressure to pay war reparations and fund domestic spending, printed marks until they became worthless. Weimar's hyperinflation remains the most infamous example of a central bank destroying an economy. The system failed its people entirely. But even that disaster didn't end the central bank experiment. It only confirmed how indispensable they had become, whether for stability or collapse. The Great Depression. A central bank failure. The Great Depression revealed their darker side. In the late 1920s, the economic boom was fueled by speculation. When the bubble burst in 1929, the Federal Reserve failed to act aggressively. Banks collapsed. Credit froze. Millions lost their jobs. Economists still debate whether the Fed's tight money policies, raising rates when they should have been lowered, deepened the depression. But one thing became clear: a central bank's choices can decide the fate of millions. Governments took note. They realized the power was not in the laws they passed, but in the hands of the technocrats managing the money supply. After the destruction of 2 world wars and a depression, the world decided it couldn't risk chaos again. The solution was the largest, most ambitious financial system ever conceived, putting the Fed at the very center. But this system was based on a lie, and one man was about to pull the plug. The global empire, Bretton Woods and the Nixon Shock. Bretton Woods, the USD anchor, 1944. After World War II, world powers sought to coordinate central banking on a global scale. In 1944, representatives from 44 nations gathered in Bretton Woods, New Hampshire. The plan was ambitious: to build a new international financial system. The US dollar, backed by a fixed price of gold, 35 per ounce, would sit at the center. Other currencies would peg their value to the dollar. This system, which also created the IMF and World Bank, cemented a simple fact: the U.S. Federal Reserve and the U.S. Treasury now sat at the heart of the world economy. Money itself had become geopolitics. 1971. The illusion shatters. Pure fiat. The illusion shattered in 1971. Mounting debts from the Vietnam War and massive domestic spending, guns and butter, put immense pressure on America's gold reserves. Foreign nations, led by France, began demanding gold for their dollars, fearing the U.S. was printing too much paper money. President Richard Nixon faced a choice: let the gold drain away and deflate the economy, or break the system. He chose the latter. On August 15, 1971, Nixon announced that the dollar would no longer be convertible to gold. The anchor of the Bretton Woods system was gone. From that moment, the world lived under pure fiat money. Currencies were backed only by government decree and managed entirely by central banks. The age of restraint was over. Central banks now had unlimited flexibility. They could, and they have, created money at will. Now that they were unshackled from gold, how would they test their new, infinite power? They would use it like a weapon to fight the greatest enemy of the people: inflation. The age of unlimited power, Volcker and quantitative easing. The Volcker Shock, 1980s. With the anchor gone, the 1970s saw rampant inflation across the U.S. The price of everything spiraled out of control. In the 1980s, Federal Reserve Chairman Paul Volcker decided to use his new fiat power like a hammer. He raised interest rates to nearly 20% to crush inflation. The result was a brutal recession, costing millions their jobs. But it also restored trust in the dollar. The Fed had shown it could reshape the economy with a single, painful policy. It showed that the Fed, not the president, controlled the business cycle. The 2008 crisis and the birth of QE. When the global financial system imploded in 2008, central banks responded with unprecedented force. The Federal Reserve, the European Central Bank, and the Bank of Japan all created trillions of dollars, euros, and yen to bail out banks and prop up markets. They called it quantitative easing, QE. For Wall Street, it was salvation. For ordinary savers, it was theft. Low interest rates and rising asset prices, driven by QE, enriched the few who owned assets, stocks, real estate, while punishing the many who relied on savings accounts. 2020, full overdrive. In 2020, during the pandemic, the process went into overdrive. Central banks printed on a scale once unimaginable. Stimulus checks, bailouts, corporate rescues, all funded by money conjured at a keystroke. The balance sheets of major central banks exploded to levels no one thought possible. The justification was always the same: stability. The cost was inflation, asset bubbles, and the quiet realization that money is now whatever central bankers say it is. You hear the jargon: interest rates, liquidity facilities, bond purchases. It sounds technical, like complex science, but the jargon is merely a disguise for the true, raw power of these institutions. The addiction and the cracks, the moral hazard. The hidden truth: power brokers, not referees. This is the hidden truth. Central banks are not neutral referees. They are power brokers. They decide who suffers recessions and who gets rescued. They decide which institutions survive a crisis and which collapse. They can inflate away debts or trigger deflationary pain. Their decisions reach deeper into your life than any election. Every time central banks intervene, they expand their role. Every time they print to save markets, they make the system more dependent on their rescue. The global addiction. Every bailout, every liquidity injection, increases the expectation that next time will be the same. The result is a global economy addicted to central bank support. This creates a moral hazard, the incentive to take excessive risks, because you know the central bank will step in to prevent total failure. Governments run record deficits, assuming central banks will keep interest rates low. Banks take reckless risks, knowing they will be bailed out. Investors chase bubbles, confident the Fed put will protect them. But history teaches us that illusions always crack. The Bank of England's credibility was shaken in the 18th century. The Reichsbank collapsed into hyperinflation. The Bretton Woods system fell apart in 1971. Every financial architecture, no matter how powerful, eventually hits a breaking point. The contradictions are mounting, and the system is becoming increasingly fragile. So, after 300 years of debt, war, chaos, and unlimited printing, what does this secret history mean for your personal wealth and future? The answer is not in your voting booth, but in your balance sheet. The final warning and CTA. What this means for you. The paradox of modern finance. So what does this mean for you? It means recognizing that central banks, not politicians, are the real managers of money. When they choose to inflate, your wages buy less. When they choose to tighten, your mortgage doubles. When they rescue markets, asset owners win and savers lose. It means understanding that the world runs on trust, and trust is fragile. If people lose faith in the dollar, the euro, or the yen, central banks cannot print credibility. This is the paradox of modern finance. The people we never vote for control the money we cannot live without. The final thesis: resilience. The true resilience lies not in the promises from bankers, but in assets they cannot create at will. Gold, land, skills, productive businesses. These have survived every collapse of monetary trust in history. The secret history of central banks is not really a secret at all. It is written in every crisis, every bailout, and every inflationary spiral. These institutions were born to serve governments. They grew by financing wars. They expanded by stabilizing crises. And today, they sit at the heart of a financial empire that spans the globe. If this deep dive gave you a new perspective on who truly controls your financial future, hit subscribe now. The answers aren't hidden in the future. They're written in the past.